Hello traders, you're welcome back to the Forex Geek channel. Have you ever felt frustrated when price breaks a key level? You enter the trade and then it instantly reverses. Have you experienced such a thing before? Well, that's not exactly bad luck. That's a liquidity fake out. Okay, so in this video, I'll show you how to beat the market by spotting these traps before they happen. Okay, now a liquidity fake out happens when price moves beyond a well-known support or resistance level, tempting to uh trying to tempt traders, to jump into the trade only to quickly reverse in the opposite direction. All right, I'm trying to find a good example for that. Okay, so for example, we can see that we had a support level around here. Price obviously respected this zone at this point. You can see that price respected this zone at this point, and price respected it here again. However, at this point there was a false breakout and price went back to the opposite direction. Same thing happened here again. Here was more like a range within this zone, and then you can see here, well, price actually moved down to an extent before reversing back up. But let me see if I can find another example, okay, because this one might not be the best example. I'm looking for the most accurate example. Sometimes searching through the chart, live charts, to find examples of specific price actions might not be always very easy. However, for want of time, let's just use this as an example. So there might be a situation whereby you might have experienced it if you've been in the market for a while, a notable support level or resistance level that price has tested at least two times and has gotten rejected. You will notice that price will break through that level, and it will look as if the breakout is a legit breakout only for a reversal to happen. So that might just be a liquidity fake out. Okay, the smart money might just be trying to grab liquidity before they move the price in the initial direction. So large players, institutions, algorithms, they push the price beyond these zones to trigger stop losses and attract breakout traders. They use that influx of orders as liquidity to fill their own positions. Remember that when someone enters a buy position, they will likely set their stop loss below the support zone, right? So we have a sell side liquidity around here, and some traders might set stop losses, sell stop orders. While traders will set stop loss for buy orders here, some traders might breakout traders might set sell stop orders, below the support level. So both the buy limit traders and the sell stop traders will likely get stopped out by that fake out, right? So think of it like a fisherman casting bait. The market dangles an attractive breakout, traders bite, and then the market reels them in the other way. Recognizing this pattern can change the way you trade, and that's going to be beneficial to you. So first of all, you have to start with market structure. You look for key swing highs and lows, okay? Places where many traders place their stops. All right. This is an example. You can actually decide to use a horizontal line, or you can decide to use the zone and just use the rectangle, tool. You can map out that zone where price has tested at least two times and have gotten rejected. So this is a resistance zone, right? This is a resistance zone that we have here. And then we can see that we have a support zone around this point, right? We have a support zone around here. So once you mark out these zones, okay, after you've looked for your swing highs, swing lows, places where price have gotten rejected, liquidity fakeouts, often occur around these zones, around obvious double tops or double bottoms, or breakouts from consolidation zones or levels right before a major news event. Then the next thing for you to do when you mark these levels on your chart, don't just look for breakouts, look for price sweeping past these levels, like what happened around here, Look for price to sweep past these levels and then snap back inside. Okay, so that is the fake out in action. So to confirm a fake out, you have to wait for the price to break the key level and lure traders in. Then you wait for price to show a strong rejection candle, all right, or engulfing pattern in the opposite direction. Okay, for example, let us look closely at what happened here. You can see that after price broke below this support level, you can see that there was a rejection and price climbed back to the upside and even tested this level. All right, then right after this test, if you look closely, you'll see that we had a bullish engulfing around here, and even see another bullish momentum candle around here, giving us a confirmation that the bulls are back into the market. Okay, so only after your confirmation do you look for an entry. You are not predicting the fake out, you are reacting to prove that it happened. So once you have gotten your confirmation, you can enter your trade, in the opposite direction of the fake out, right? So once you've gotten your confirmation candlestick pattern, you can enter your trade, you can place your stop loss just beyond the low. That is, it's a buy trade, but if it is a sell trade, it's going to be above the high, right? Just beyond the high, okay? So it's going to be beyond the high or the low of the fake out week. Okay, your first target can be the opposite side of the range. All right, so can be targeting this zone. Okay, and if momentum is strong, you can aim for a larger move. Okay, so you're going to watch out for how the momentum is in the market. If you notice a stronger momentum, then you can aim for perhaps the next resistance zone. But if you notice that price is trying to struggle to go past that resistance, then you can just exit your trade around there. So this is where discipline matters, right? Not every breakout is a fake out. Sometimes price truly breaks and runs. And that is why you wait for confirmation. So never trade based on the first candle that pierces a level. Liquidity fakeouts are one of the most common ways that retail traders lose money, and one of the most profitable patterns once you know how to spot them. By understanding why they happen, marking the right levels, and waiting for confirmation, you can flip the script and trade alongside the smart money. So if you found this breakdown useful, click the like button and subscribe so you never miss strategies like this. Drop a comment below with your thoughts on liquidity fakeouts. Let us start the conversation. Until next time, trade smart.